Okay, before we head into the market outlook this week, for the Applied Series subscribers, let me explain some changes that you're going to see starting on Wednesday. Just some reorganization. No content will be lost. And for some of you, you'll actually get more content than you originally had planned for. But we're streamlining this a little. So this over here, Applied Futures and Options on Futures, will be collapsed and just simply moved over to the Applied Options course because it is options on futures. So it's futures and options on futures. We're going to stick it in the Applied Options course, and I'll continue to update this with more futures contracts, even if they don't have options on them, but it just makes sense to put them here. So that one will disappear as a separate module and will just show up in Applied Options. This over here, Applied Bottom Up, that is going to go and simply show up inside Sector Studies because it is particular companies that I do a long analysis of, 4 to 5 hour videos. Well, I think they're better off in the particular sectors in each of those. So I think this is the more exciting sector module, really, the sector studies. Working on energy now. It is going to be a long one as well, and I will then, this is the sector study for energy, and then I will do the oil and gas exploration and production industry within this for a longer video, and I will be using Occidental Petroleum, as the example throughout that video. So Applied Bottom Up goes into sector studies, that disappears. Applied Macro and Top-Down Analysis, that goes away as well. Some of the content will go here, some of it goes here, and some of it goes here. It's better aligned in each of those three. So that will go away. So in the end, there will be 3 modules. There'll be Applied Options, which is currently $220. There will be the sector studies, which will be listed separately for $220. And then there's portfolio construction and management, which has another, I think, 20 weeks to go, because there's some higher level stuff that we're going to get into, but we got to get through the basic stuff first before we get to higher level strategies. There's about another 20 weeks there. Right now this is 125, but it will rise to 220. Those will be the only 3 modules, and everything else will go into those 3 modules. All of this stuff here will go into another folder called Extras, which means if you are subscribed to any one of these modules, you will also get the Extras folder. And if you have the Applied series as a whole, you get everything. So right now the Applied series is $320 USD. Applied Options is $220. Sector Studies will be listed for $220. Portfolio Construction sitting at $125 will rise to $220. As of November 30th, all 3 of them will be $220 each. And this price here will rise to $440. In other words, if you buy 2, you get 1 free, which I think is kind of a good fair deal overall. So November 30th will be the price increase. You'll see this happen Wednesday. So if you're looking at all of the icons you have and you say, well, where did this go? Where did that go? They've just been collapsed into other modules. There'll be 3 modules when we're done. No one loses anything, but some people gain. There are some who only subscribe to portfolio construction. Well, you're going to get some of the content that was in the Applied Macro. There are some that only subscribe to the Applied Options. Well, you're going to get some of the stuff from Applied Macro and the stuff from Applied Futures and Options on Futures as well. Just so that you see, on Wednesday you log in, you go, where'd everything go? It's there. It just collapsed into the other folders. Okay, third quarter behind us, and not a very good third quarter for bonds. It wasn't very good for SPY either, but it was fantastic for the US dollar, and it was fantastic for oil, which is not a very good thing for countries that are net importers and pay for that in US dollars. We're going to have a little chart on that a little later on. Friday morning looked good. PCE came in rather benign, 0.1 on the core month over month. That looked very good. But then the clown show in Washington sort of took the whole day away, and we ended, especially in bonds, not quite on a high note. Certainly a big difference from 8:35. 5 minutes after the report, it looked like, okay, it looks like we're going to have a good day. Rate hikes are probably done. And then by the end of the day, it was, well, all of that is gone. And then Saturday, we did get a stopgap measure, an extension, kick the can down the road, buy us some time to get a deal done. So we'll see how that plays out when the market, when futures open at 6. And even with that, I have found lately that what you see in Globex the night before has very little resemblance to what actually happens when Americans show up at the trading desks 7:30, 8 o'clock the next morning. Also more drama on the Hill. Matt Gaetz on one of these Sunday talk shows says he will be looking to have McCarthy vacated from the speaker's seat. What would Washington be without the clowns, right? Let's have a look at where our rates are. Money market rates all being very well behaved. Hardly any movement going on there. It was an end of a quarter, so usually you'll see some interest in the 1 month, and reverse repos tend to build up into the end of the month as well. And I think not just the end of the quarter, but the end of the year for some reporting funds. Capital market rates seem to be rather well behaved from the 2 to the 5. It's the long end of the curve that's really getting punished. The 10, the 20, the 30, the 10 tied to mortgages. The 20 is an odd tenor, but the 30 is a big number here, up 20 basis points. I can't even begin to tell you how huge a move that is on a 30-year. How big a move that is, but we have a bear steepening going on. How can we tell? Rates going up is bearish for bond prices because rates up, prices down. Rates going down are bullish for bond prices. So you could just look at the direction of rates and you've got your bear or your bull. And then you can look at the difference between the 2-year and the 10-year. And if that difference is becoming less negative, or more positive, that is called a steepener. A steepener happens when long rates increase more than the short rates, and a bull steepener happens when short rates drop more than long rates. And right now we have a bear steepener going on, which is a rare thing, especially at elevated rates. A very rare thing at elevated rates, and it can break a lot of stuff. And I think it is because of this on the end of the curve that the Fed is probably done. And I don't know if it was because of what happened with rates over the last little while or what happened this week, but my God, the Fed speak calendar is full next week. Almost everybody with a mouth is talking next week. We'll have a look at that calendar. Have a look at the 2 to the 10 steepening, 22 basis points. All of this is steepening, 22, only inverted by 44 now. And the 3-month to the 10-year under 100 basis points, only inverted by 96, steepened by 16. Canada is still deeply inverted. Canada, the 2 to the 10 is about 85 basis points. And the 3-month to the 10-year still over 100, sitting at almost 110. The Fed balance sheet on top of rates going up at the long end of the curve, the Fed balance sheet continues to run off as well. Another $17.5 billion from the SOMA, and from the balance sheet, another net $4.5 billion has run off, and funds still keep going into money market funds, increased by $6.3 billion. Retail is the guilty culprit here, up 7.8 in both government and prime. And institutional down 1.5 in both government and down on prime. and the funds flow, and I found this odd, the funds flow into TLT are hitting records. Funds flowing in to TLT, into the long bond. So it could be that institutions are pulling money out of the short end of the curve, grabbing yields on the long end of the curve. I was buying the 25-year, the 2048, at yields of 4.9, I think 4.97, 4.98 I was getting at one point. And I had found a 2040 bond with a 1.375% coupon. If you're a foreign buyer buying US bonds, what you want to do is find bonds with the lowest coupon possible. This was selling for 54%, 54 and change. So you're basically paying $540 for every $1,000 bond. It has a very low coupon, so the withholding tax is very, very low. Most of your gain is going to be within the capital gain. It'll have a very high duration for its tenor, considering its low coupon. It was at 5.02%. I didn't pick any up, but that was my next target. That had rates continued. If we had continued with the steepener, I'll move from the 2048 to the 2040, and I'll buy this one because it is far more tax efficient at the 1.375% coupon. November 1st, FOMC meeting 31 days away. We get the September minutes in 10 days. JOLTS we get in 2 days, and the jobs report we get in 5 days. I put question marks beside these because when I had done the screen, there was still no resolution on the government shutdown. So the question was, are we even going to get them? Well, we are going to get them now, so we can take that out. The probabilities for November, 0 up to 85% from 73%. I think that's the right move. 25% is down to 14.2%. And for December, I think this is the right move as well. All the probabilities shifted down to no further hike, staying where we are, gone from 55% to almost 64%. The 6%, there's still some weight there. That's dropping to 3.7. It's end of quarter, so it's really hard to, when you're looking at December and November, looking at the combination of the November month end and the December month end, it's very hard to determine exactly what the market is inferring for probability, because some of the activity in the Fed funds futures is for hedging. And when you hedge, you have to sell. And since it's an index 100 minus R, when you're selling, you make R appear to be much higher because you're pushing the price down, which means that it's doubtful that there is any probability at 6%. It's just given that I just so happen to be looking at it at month end, there is probably a lot of hedging that's in that, maybe putting more probability at 6% than there necessarily has to, and even more probability at 5.75, that if anything, the Fed funds futures at any point in time probably overstate the probability of higher rates, or said another way, understate the probability of the lower values. So it's probably higher than 63.7 on the 5.5. I would say that this is probably non-existent at this point, because that would imply a November move and a December move. I don't think there's any probability there. I think the probability showing up there is hedging pressure, making it appear that there's probability. So these are not, said a better way, these are not as far as a definition of a probability, they're not market probabilities. They're implied probabilities. They're implied from where the pricing is, but some of that pricing is the result of hedging pressure. So because hedging requires selling, we can always conclude that the probabilities to the upside are overweighted. New York Fed, effective federal funds rate 5.33. That doesn't really move that much. Reverse repo, this is not surprising. I wouldn't read anything into that. Up 156 billion. It's the end of a quarter, and also for some funds it's also the end of a year. So this always happens at the end of a month. it's bigger at the end of a quarter and even bigger at the end of a year. So I wouldn't read anything into that. Look at our Fed speak. Look what's going on here. Monday, Powell, Harker, Barr, Williams, Mester. Tuesday, Bostic. Wednesday, Schmidt and Bowman. Thursday, Mester, Barkin, Daly, Barr. And Friday, you have Waller. Everybody with a mouth is speaking, except Kashkari. He was last week. I don't see him on here this week. Williams, where is he? He's on. He's sort of thinking that it's done, and that the Fed will need to cut rates next year just to keep a real rate restrictive without it getting too restrictive as inflation comes down. Looking at our lags, figuring a 12-month lag, there's still 225 basis points of hiking left to be felt. So it'll be interesting to hear what has to be said this week, because we have high rates. You have a restrictive real rate, both in terms of the federal funds rate and in terms of where T-bill rates are. All of them are real rates, and you have elevated real rates all over 2% at the 5, the 10, the 20, and the 30. So you have real rates across all of those, and over 2% would suggest restrictive. The Fed, based on long-term projections, the real rate for the federal funds rate, the real federal funds rate is 0.5%. We're sitting at about 1.85% now. So you have elevated nominal rates, elevated real rates. You have a bear steepener going on the long end of the curve, which is just raising bank loan rates and mortgage rates. And you still have balance sheet runoff going on. So there is still a lot going on. I think the Fed is, if you look at all of this, you say, well, I think you're done. You also have unions that are demanding higher wages and striking, which at the margin will lower demand, because there are a bunch of union workers on strike now that are not going home with paychecks. So they're not going into the mall. So that will take inflationary pressure off while they're doing what they're doing. There is some thinking that, well, all of this is only going to be inflationary. All of it is going to be inflationary, because if unions are getting 30% wage hikes, and in the assembly of a vehicle, wages are about 10%. Labor makes up about 10% of the vehicle, and they're getting a 30%, or at least it looks like they'll land somewhere around 30%. If you take a $60,000 vehicle, that means $6,000 is labor. That'll go to $7,800. And if that is going to be passed through, this vehicle is going to go to $61,800. But it's not going to be passed through like that. Company's going to want to preserve margins, so they'll want a margin on that as well. So that might go to $62,500, which is getting close to 4.5–5% inflation on vehicles. New vehicles make up 4% of CPI. More damaging than that is that union wages set a floor for all other wages. That if I can get that much delivering UPS packages or on an assembly line at one of the big three, why would I work for you for significantly less? You're going to have to pay me more. So there is some thinking that in the end that will probably only be inflationary. It's possible that it could be inflationary. It is also possible that it tips the scale in favor of automation. That a net present value analysis says, hey, it's cheaper to have 1,500 employees rather than 1,000 employees with capital. This might tip the scales and say, no, it's now cheaper to have 1,000 employees with capital than to have 1,500 employees. Also, there is the productivity effect. Yes, you're going to pay workers more money, but if you can find a way to increase productivity at the same time, then your cost per unit, that is the more important thing, is the cost per unit that we look at. And I think we get the next productivity numbers, cost per unit, at the end of October for the third quarter. That is the more important measure of the possibility of inflation. To say wages are going up is going to be inflationary is to discount the strategic response in response to rising input costs. Number one is avoid the input cost. Shift work to Mexico, shift work to the right-to-work states in the South, invest in automation, or find ways to increase productivity. All of these things can be done. One of the interesting things that I thought about over the weekend is Ford and GM have been very hesitant to break themselves up. In other words, to split themselves into 2 or 3 companies. Now, operationally, they seem to have aligned themselves that way, but to actually split themselves up is to have an internal combustion company and spin out the EV company so it can be priced more as a pure play. It would unlock shareholder value. For GM, they can spin out Cruise as a separate company. They can spin out the EV line as a separate company and keep ICE that has the union. And if ICE has limited life, well, give it to the union. Load up on that and say, well, there we go, and have a clean EV division that then is free to have its own capital structure, free to have its own plants, its own locations, and perhaps a lack of union representation in there. It is possible that if the union is too successful, that the car companies can retain the option to say, well, why infect the new company when we can just isolate it to the host? And maybe you'll hear more conversations about that. Okay, real yields, all of them hit new highs last week, September 27th. And there's the cycle highs here. Here is where they ended for the week. You still have an inversion here of 14 basis points, not as much as the week before, but still inverted, all well over 2%. All real rates well over 2%. Inflation expectations 5 to the 10. Well, let me change that. Break even, inflation break even rates have dropped from the 5 to the 10. The 20 to the 30 they've increased only because the 20 and the 30 on the nominal yields increased so much. I don't know that I would put much meaning into those particular numbers. Fed funds futures. This does not tell me that the market is feeling, even if we account for hedging pressure, you still had the curve rise week over week, meaning that the implied rate has dropped even with hedging pressure. This is not suggestive of a Fed that's going to move, it seems. We have January and February bottoming out at 94.575 with an implied rate of 5.425, which is pretty much where we are. We're at 5.33, 5.425. Last week was 94.535 with a rate of 5.465. So it's actually lower by 4 basis points. If you go to mid-year, which is June, implied rate is 5.235, sort of implying that maybe there's a rate cut in here. Last week was 5.28, so it's lower by 4.5 basis points. So the Fed funds futures, which is reflecting the average of the month for the effective federal funds rate, is not higher but lower. Not by much, 4 basis points, but this is not a curve that's suggesting that there's a rate hike coming. Effective federal funds rates 5.33%. The PCE, we have August PCE now, 3.5%. That gives us a real effective federal funds rate on a look back, just looking back over the last year, currently 1.83. Now that is assuming that is our go forward rate as well. Which, if you say, well, what's the best number to use? The current 12-month is the best number, and maybe it gets better, or maybe it gets worse. You're at 1.83. If you took the core and you simply just annualized at 0.1, you'd be much lower on core. Headline, you'd probably be right where it is right now. So I think we have a fair enough number at 1.83. The real target is 0.5. So they are sufficiently restrictive on a real rate, which means they're sufficiently restrictive on a nominal rate. So I don't know that there's another rate hike in there. That might have been signaling to the market so that the market doesn't run away on itself and attempt to undo what the Fed has done. Maybe it was there for that. Maybe it wasn't the intention to raise rates, but maybe it was the intention to signal that they want to raise rates, because of course the market is a variable that they can control. Going to December 24 versus December 23 on 1 month SOFR, 471 and 541 is 70 basis points lower. At one point it was over 150 basis points, implying 6 rate cuts over 2024. This is now down to 3 rate cuts. It was 84 last week, and the last summary of economic projections we had was suggesting 50 basis points of rate cuts over the year. So these markets, along with the Fed, are coming in more into alignment. TLT down 3% on the week. Not a pleasant week for TLT at all. SPY down 0.7%. For those of you looking at the options, there is implied volatility here. 13-week at 94%, 26-week at 91% versus 50 and 34 the previous week. I added more to my bond, the 08, the August 11th maturity in 2048 3% coupon bond. I added at 4.84% and at 4.96%. So I keep moving money into the long bond because it's a nice vehicle on which to eventually move my money from the current brokerage system to the new brokerage system. I did find, as I explained on the previous screen, a 2040 bond, a 17-year bond with a nice low coupon. It was yielding over 5%. When I saw that, I said, okay, well, I've got enough here on the 25-year bond. I have a lot of T-bills, because that's a nice way to move money around too, without it just sitting in cash. You want it sitting in something earning without any risk. So I have no duration risk over here. I got 3 months to 6 month T-bills. I've got lots of duration risk over here with the 25, and adding something in the middle sort of starts to appeal to me now. And with such a low coupon, it will have a higher duration than a typical 17-year bond would have, but it's the withholding on the interest. Because the interest component is so low, it's an extremely tax efficient U.S. government bond to hold for non-U.S. citizens, because the withholding is only 30%. If you don't have a tax treaty. If you have a tax treaty, the withholding is 15%. So if you don't have a tax treaty with the U.S. or your country doesn't, it's 30% of such a small amount. So you'd get 70% of that, and the difference is made up in the duration. It would be delivered in the capital gain, of which there is no withholding. So if you are, as I will be, in a territorial tax regime, that capital gain is delivered to you tax-free, and the only tax I would pay is 30% on such a low coupon. And that coupon is on the face value. So you get this coupon on $1,000, but you're only paying $540 for it. So your cash yield, right? You got to figure out what your cash yield is. Take 70% of this and divide it by 540. That'll give you your after-tax cash yield. And then, of course, the rest of it is capital gain. Okay, corporate spreads. And again, corporate spreads are saying nothing to see here, but we are getting some kind of movement on high yield here. The high yield is a group up 20 basis points over 400, but still low. Anything below 500 is considered rich on a blended high yield. The triple C's just over 900 basis points, now 31 basis points, but not much movement on any of the IGs. Look at housing. Look at these mortgage rates, 7.31%. That is starting to get crushing, isn't it? Up 12 basis points. The 10-year Treasury was up 10 basis points Thursday over Thursday, and this is up 12, so the spread between it is widened by 2 basis points. Negative for mortgage REITs, which we're seeing in agency and Annaly, but ABR is showing some nice resilience here. The REIT index down 2.56%, PLD and DLR both down as well. The longer or the higher rates go, the higher the spot curve ends up being, which means the present value of all those future cash flows are lower. Those are the right moves. Those moves make sense. For the first part of the year, what wasn't making sense was rates were going higher. And IYR just wasn't responding. In some cases, rates would go higher for 2 weeks in a row, and IYR would go higher. It's like, well, explain the math to me of how you're getting that done. The only way you can get that done is if you have a forecast for net operating income that's going to grow faster than the rate at which rates were going, and we've had the fastest rate cycle hiking history, the fastest rate hiking cycle in history. Are you suggesting that we're going to have the fastest NOI growth in history as well? I found that confusing. But IYR is under $80 now. And I think that if you have more bear steepening, there is more downside to that index. Housing, there's the biggest uncertainty here because you have two big forces. Both in Canada and the US, you have an undersupply of housing. The last report I read for Canada says that it would take 10 years just to clear the backlog for housing. 10 years just to clear the backlog at the rate that we're going now. And if you increase immigration and you have higher rates, which deter more home construction, because the builder has to finance all of that at higher rates, it will take actually even longer. 10 years just to clear the backlog. So I don't know that we're in any fear of a big housing crash at this point. So on one side, you've got a significant shortage of homes. On the other side, you have unaffordability going up every day. Which one is going to win out? In the US, I think the shortage wins out over the unaffordability. In Canada, I'd put even odds on that because you do have shorter term mortgage terms before renewal. It's not as if you can sit on your fixed rate mortgage for the next 30 years. You can't. At some point, you must show up to the bank and say, I would like a new mortgage, please, and you're going to reset at higher rates. Same with the UK. Is for that reason, I think Canada, the Bank of Canada, is done raising rates, and the dollar, I think, in sympathy on Friday, the Canadian dollar really lost value against the US. But in the US, a bit of a different story. DXY 107, I think it ended at under 108. I think is starting to look attractive. Lennar, I think, sitting at 110, 112. Pulte, KB, Toll Brothers, Hovnanian, all of them kind of uninterested in things, but the two biggest ones had the biggest drops. XHB, a little bit of a gain. ITB, a little bit of a loss. This is really impressive. The housing price index, this is year over year. For July, month over month, up 0.8, but look at year over year. Housing prices are still up 4.6% year over year after you've had 525 basis points of hiking. Well, I mean, we're July, so we can probably say about 400 basis points because some of the hikes happened before July. This is purely a supply issue. Existing home sales or existing homes have largely come off the market. There's still some there, but if you don't have to, it's gone. You have a housing shortage, and it's keeping prices elevated. Case-Shiller month over month 0.6, year over year 0.1%. It was negative for a while, negative 1.7. Now we're 1%, 0.1%. New home sales. This is a tough one, right? August month over month down 8.7%. This is in line. Last week we saw the National Association of Home Builders index below 50, suggesting contraction And last week I mentioned that we have new home sales coming this week for the month of August. And given what the NAHB had been doing, it wouldn't be surprising if that came in negative, and it did in fact come in negative. Mortgage apps down 1.3%. Pending home sales for August down 18.7 year over year, down 7.1% month over month. You know, you have, if we think about it in terms of a scale, you have on one side you have supply, right? And on the other side you have affordability. And they appear right now to be coming into better balance. Yes, you had unaffordability before, however, supply was the heavier weight. The lack of supply was sort of still leading the market and helping the home builders perform. But as you add more and more interest rate hikes, I wouldn't say interest rate hikes, let's say yield increases at the 10-year, which leads to direct increases in the 30-year fixed rate mortgage, you start to bring these into better balance. That yes, we have an affordability issue that is climbing, but yes, we have a shortage of housing that is not at this point, between new home sales and existing home sales, keeping pace with the rate of new family formation in the US. Even worse in Canada. The big difference in Canada is on the supply side. In the US, you can take supply off the market for 30 years. That doesn't happen in Canada. So there is less weight on the supply side in Canada, so it is more likely that you'll see this kind of thing in the Canadian housing market, shifting from still a seller's market to maybe a market that is in better balance. I know that in my neighborhood, every time a for sale sign goes up on a house, it's gone within 30 days. However, there is one house on my neighborhood that has been up for sale for 56 days. And on Friday, my realtor, because I'll be listing my house shortly, my realtor sent me that listing, and there was a price drop. They went from I think they were at 1,795, and they went to 1,495. $300,000 drop. Now, my home is upgraded and superior to theirs in square footage and amenities and in the quality of the interior. So I'm not too concerned about that, but that is rare for this neighborhood. That is rare. So being that that is going on, it's not surprising. It is more common to see this happen in middle market neighborhoods. But in this particular crescent that I'm on, it's rare that you actually see a price decline, a markdown. Usually it goes, and it usually goes for its asking, if not over its asking. So this is, maybe a sign of things to come. Maybe it's particular to that particular house. It does have a very particular presentation from the street. It's kind of pinkish, kind of dark rose pinkish colored. Maybe that could be it. I don't know. But it is rare to see that. Okay, what have I got here? I've got two ETFs. I've got BNO and USO. USO tracks WTI. BNO is Brent. Here, DXY is the dollar index, and we're all very familiar with TLT. This is a quarter to date, just for the quarter. TLT down 13% in one quarter. Brutal. When we talk about the fastest rate of Fed hikes in history, if we go to the long end of the curve, it's probably the fastest rise in long yields in history as well. When you can get a very quick rise on the short end of the curve without it being a quick rise on the long end of the curve, and you get an inverted curve. Well, this is starting to happen now, so your curve is becoming less inverted. It's been punishing for TLT. I'm not sure the last time we're looking at the possibility of 3 years in a row of negative bond returns. I'm not sure how far back you have to go to find such terrible performance on bonds, especially US bonds. I don't know how far back you got to go. Dollar index is up 3.1%. And the more damaging thing is look at USO and Brent for the quarter. 27.24 on WTI, 26 on Brent, call it basically 27% each. This is a problem. This is a huge problem for countries that are net importers of energy, and not only net importers of energy, but also pay for it in US dollars, because they need to get US dollars. Well, US dollars are more expensive in their currency, and energy is more expensive in their currency. So it's not just that energy has gone up in their own currency. Energy has gone up in US dollars, and the price of US dollars is higher. So there was this concern, this puzzle I had several weeks ago. You have equity markets that were selling off. You have bond markets that were selling off with the US dollar going up, and I kept thinking, where's it going? Where could it possibly be going? Well, if you have energy prices rising at this rate, and you have countries that are net importers of oil and gas, particularly here oil, because we're looking at WTI and Brent. Even though the U.S. is a large natural gas producer, it's still, in terms of exporting LNG, still not a very big enough market yet. But WTI and Brent, for trade denominated in U.S. dollars, for a rapid rise like that, countries that needed to buy U.S. dollars had to sell their currency to buy the U.S. dollars, simply to transfer that money to an oil company or a downstream company. Let's just say a downstream company. Whether the oil company had downstream operations or not, who cares? But we'll say to some downstream company. That's where the dollars were going. Is to afford that, because this is a puzzle. You know, if you have financial assets, both equities and bonds, going down in value with the U.S. dollar going up, that means money's coming into the U.S. dollar. Where the hell is it going? And it could just be that there was demand for the U.S. dollars because of this going on here. Not only did you have a rise in energy prices, significant rise in one quarter, 27% in one quarter, you also had to pay for it with more expensive U.S. dollars. Japan creates a bit of an issue here, because Japan, we're sitting at about 149, 149.4 on the currency. They don't want to do anything to the interest rate. They don't want to touch the interest rate at all. However, there has to be a concern about this. And there has to be a concern about this. Now, I think they import more natural gas than oil, but still, the yen has fallen by more than what the strength of the DXY would suggest. DXY is up 3.1 on the quarter. The yen is down significantly more. You don't want to touch an interest rate. What can you do to fix this problem? You can intervene in the currency to drive the yen higher, which means at a lower exchange rate, 140, 135, 130, while maintaining your central bank policy of where you want to be on the interest rate. Central bank can still work on the currency. So it would not surprise me, and I'm not predicting it, but it would not surprise me if the central bank at some point decided to punish the short sellers of the yen and intervene to drive up the price, because this is a problem. Okay, let's have a look at S&P 500. We have earnings that are going to begin in 1 week. Q3 earnings begin the week of October 9th. Not this week. I think this week you have 2 stragglers left from the S&P 500, and then we begin anew next week with the financials, the big banks leading off. Forward 4-quarter operating earnings 232.92, S&P Global's 230.28, but I don't have the updated numbers, so I'm just going to use the last one that we had. S&P closing 4288 on the index gives an 18.51 times forward earnings. The 200-day moving average and the 50-day sitting at about 419 and 444. And if we look at the uptrend and the downtrend line, the uptrend sitting pretty much at 419, downtrend 448. So we're somewhere between, probably call it 419 and 445 on a very high level technical level in terms of where the range is right now. Technical range, not the sentiment or the fundamental or the behavioral range, just the technical range. Implied volatility is back. Now look at the 26-week implied volatility, 87% versus 79% last week. So if you want to do something with options, you could. I can't because I'm trying to engineer my exit from Canada before the end of the year. So let me give you a little timeline here. There's the end of the year. If, let's say, I leave somewhere over here, let's say this is 45 days into the new year, I got to file a tax return here, of which I will have objective tax forms for, because I get tax forms for year end. Then I have to file a tax form here in the absence of objective tax forms, which just makes it more complicated and expensive to do. So if I can engineer my exit over here, then I do have these tax forms that come in. I'd still file an end of year tax return, but I would be done. It saves a lot of work. It saves a lot of work and a lot of trouble if I can engineer the exit as close to the end of the year as possible, so that there's no revaluation that would be expected of any property I buy outside of the country. Divorces, they're never good, are they? I am divorcing Canada. Let's have a look at Q2. Let's head down here and have a look at Q2 GDP. We got our final look, and corporate profits is part of that, down to an increase of 0.5, came in lower. The forecast was for 1.6, came in at 0.5. Q1 was increased, so it was only down 4.1%. Trying to get some idea of where the trajectory happens to be. Let's look at Q2 2023. Net profit margins came in at 11.1. If we go back to Q2 2022, they came in at 12.2. And if you go back to Q2 2021, they came in at 13%. So they have been dropping each year, 80-90 basis points each year. The S&P Q2 earnings surprise was 7.9%, but we have to be careful about this 7.9, because what happens is as you get closer to earnings season, it's not uncommon for earnings estimates to drop. And then as earnings come in, let's say you get results here, either estimates continue to drop or estimates start to go up. And if estimates continue to drop as earnings come in, by the time you're done, you look at where you were here, there's your 7.9%, but it might be negative 1% from where you were at this point in time. So the beats are kind of misleading to say, well, it beat by 7.9%. It beat the expectation by 7.9%, but lowered and lowered and lowered expectations. As earnings season was unfolding, perhaps some earnings that were happening later on got downgraded. So let's say the big banks report and it's not very good. The regionals would be downgraded. The earnings estimate would drop before they report. And if they beat that new lower number, which might not have beat the previous number had it not been downgraded. So you must be careful in interpreting this number. So I don't know that we could read too much into that in terms of, well, what do we expect? That if we were thinking about, our income yield, if we were thinking about the percentage change in earnings and about the percentage change in the PE, this is the wild card, because these two tend to have a positive correlation, or at least in a logical, rational world, they have a positive correlation. Income component, we figure about 3%. Combination of dividend and share buybacks, it's the percentage change in earnings. And Q2 showed that it's only 0.5%. However, Q1 was negative 4.1, so that is actually an increase of 4.6% quarter over quarter. from Q1 to Q2. But net profit margins have been dropping for Q2. We don't have the Q3. We won't get Q3 corporate profits, I think, till our first look at it will be November. So at this point, I'm not really sure. This is the S&P 500. It is the largest 500 companies. It is not corporate profits. It's S&P 500 profits, but they do track the broader population. Even though the S&P 500 is a sample, it represents a large amount of the corporate profits versus the sample. However, they are bigger. I do believe the U.S. is entering a phase of what I call large cap capitalism or large firm capitalism. Japan is been in large firm capitalism for a very long period of time. This is an environment where it is difficult to survive as a small company, and bigger companies just get bigger and bigger because of the death of a lot of smaller companies. At these level of interest rates, smaller companies are affected more than large companies. Large companies are more sophisticated, probably have a lot more fixed rate debt in their capital structure than floating rate debt, and probably more investment grade, especially at the S&P 500 level, either the upper parts of high yield, if anything, or investment grade. And probably a lot more sophisticated on interest rate hedges, so probably more resilient overall. And since this is an index of 500 companies and not an index of corporate profits, again, you have to sort of look at this number and say, well, that is all corporate profits. If you look at the distribution between those at the bottom and those at the top would probably be your S&P 500 companies. Maybe they'll be, okay in that sense. So to sum up, going into the week, I think the risk event of the shutdown is in the back seat. No earnings really. I had two stragglers from Q2 this week, but we don't start that till next week, so that's in the back seat. We got Fed speak, a lot of Fed speak. However, that may be actually good for the market overall because you will have diversification. You have enough of a big enough sample that you should have diversification. So we should end up by saying, well, we're pretty much where we thought we would be. I mean, if you were only hearing from the hawk or only hearing from the dove, you'd only have one thing to take away, but we're hearing from the group. So we will get the group opinion, of which I think we already know the group opinion. So other than a headline here or there that might cause some short-term volatility, that's probably in the back seat as well. On the economic calendar, you have two ISMs, Monday and Tuesday. If they don't shake the market that much, maybe that's in the back seat. And that, I think, wraps up this week.